With me this morning, I have Gerris Dixon, the audit leader for insurance for the Africa firm. I'm Andrew Warren. I look after the advisory businesses for insurance. And together we're going to unpack what we've looked at in our outlook, what's happened to the industry, where we see it going, and what we feel are the important aspects to be facing in the future. Gerris, welcome.
Thanks, Andrew.
We're going to unpack the financial results of the industry. I think the publication has got the financial analysis of what's gone on in the listed market, but a lot has happened since those numbers are produced.
Yeah.
And then we'll move on to having a look at what's happening from a regulatory perspective and then from a transformational perspective. But let's start with where the industry's come from over the last year, how it's evolved. This is our fifth publication, and we've been watching the numbers over the last 5 years. What's the analysis saying, and what are we aware of in terms of how the industry is performing?
Yeah. So as you say, the first article you'll find in this publication is an overview of the 2024 financial results. So let me just almost caveat what that means, and then I do want to make a few references to what's happened in 25 to date. So what we do is we take for the four large listed insurers, and we also add Liberty to that. So the four listed insurers are Old Mutual, Sanlam, Momentum, and Discovery, and Liberty. So between those five insurers or insurance groups, we then produce results for them for the 12 months ended 31 December 2024. Now, you may say, we produce the results. What I mean by that is for those reporters that don't have a 31 December year end, we use their 6 monthly results and combine them and get an annualized result. So then you've got a comparable base between those five insurers. And then we compare some of the key metrics, and being an accountant, those in my mind often are profit before tax, profit after tax, total assets, total liabilities, and equity. But then we also ask our actuarial team to do an analysis of those insurers that report embedded value results. So you'll see this is a combined article between the accountants and the actuaries. So SPARE is our actuarial partner that analyzed the embedded value result and value of new business. Okay, so that's the context. And maybe one more thing before I dive into the numbers. These are consolidated insurance groups. So, for example, Discovery has the SA business in it, but it also has its UK business in it. So one needs to see those results in the context that it's not just reflective of the South African market, but it is the lead indicators of the South African market are in there. And also, all five of these groups have got a life insurance presence and a short-term insurance presence. So often the nature of the assets and the liabilities of the life businesses are so big that it dominates the balance sheet. But what one must not forget is the contribution that the short-term insurers make to the bottom line. So that's also a bit of context I want to add there.
But I think also building on that, and we'll talk about it later as well, is that these entities that we call insurers are more broad financial services entities, and you're missing out the asset operations and the savings and investments businesses that are embedded in most of these entities as well.
I couldn't agree. But when you look at, and we'll stop the theory, but now, when you look at these consolidated balance sheets for these insurers, actually the asset management businesses that they control are consolidated in there. So you're absolutely right. You know, one uses the term insurance group, but there's a lot in there, right? So a number of them even have banks in them, right? So we can talk a little bit about that later.
Yes.
Okay, but let's do the highlights. So the 24 calendar year was definitely a good period for the insurers, or for the insurance groups. So we saw that the profit after tax for those five insurance groups increased by 40% to to 47 billion rand. Now that's it's nice to see that the industry. In our previous Outlook publications, we've talked about how the industry has recovered post-COVID. I think this was a year where the mortality experience was a lot better, but definitely what's helped those insurance groups has been the investment markets, right? So we've seen a general recovery, and to your point, so an insurance group is not all about mortality, morbidity, car accidents. It's also being able to make a turn on the assets that they manage. So that definitely is a key driver there. I think if I switch to the short-term insurers, a key metric for them is gross written premium. Now, the short-term insurance industry in 24 and what has carried into 25 has had a purple patch. So for that metric, what we do in the publication, we aggregate the quarterly reporting by the Prudential Authority on the short-term insurers, and we annualize that. And if you do that, it shows you that the short-term insurance industry in South Africa generated gross written premium of 225 billion rand, which is a sizable number. It's up 9% from what it was the previous period, the comparative period. But the real nice part of that result, again, is also a 9% number that sits in that underwriting margin. So underwriting margin, in simple terms, means profit, right? It's the portion of the premium you did not need to pay out as claims or as expenses to manage that business. So the short-term insurance industry definitely is having a good time, and I'll come back to that a little bit later.
And that's been a big turnaround since 3-4 years ago in terms of particularly the underwriting results.
For sure. And again, there's many factors at play here, but a key driver is that the short-term insurance industry has had a benign period when it came to catastrophes. So, and benign is maybe a strong word, but has had a much better period than the years before. So, a lot has been said about the fact that South Africa was always seen as a low cat environment, and then we've had a number of years that we've had material accumulation loss events. That has not happened, as I said, in the past year. It doesn't mean that the world has changed, right? But it is nice to see the short-term industry be able to produce results in a year that they did not have these cat events.
And interestingly enough, there was an article in The Economist this week around the benign markets for the short-term insurers globally as well.
Yes.
And even with some of the big fires in Los Angeles, there's still quite a low cat environment globally, which I think from that perspective might soften the reinsurance market and put some pressure on the premiums to come down from an insurance perspective.
So for sure. So you and I both know that the firm's global publication that has the same name of what we're talking about, the Africa one here, makes reference to an expectation that globally short-term or non-life or P&C premiums are going to taper down. We've not seen that in South Africa. As I said, a 9%, an 8-9% growth in gross and premiums is in excess of CPI plus GDP growth. There are, I think, unique reasons in that claims inflation is not the same as CPI. And some insurers are saying they are entering new markets that they haven't been in before. So hopefully that trend continues. But you're right. It's definitely not, the South African trend is not following the global trend as it relates premium volumes.
Yeah. So moving to the life side, quite a different story.
So the life side, from a profit perspective, was, as I said, was solid, very solid. Nobody can say that a 40% growth in profit is not something that you would want. The challenge with the life side is what's under the surface there is the current year results are not always reflective of the new business sales in the current year. For that, I think some of the other metrics in that same article, and it's hard for an accountant to say this, but potentially some of the actuarial metrics give you a better indicator of what's happening. So the value of new business margins for those insurers that report that for 24 it was holding up compared to 23, but you could see it starting to creak, and definitely in 25. And when I talk about 25, as we sit here today, we've had sight of the interim results of the insurers with December year ends that reported at 30 June 25, and there's 2 of those 5 insurance groups that have got June year ends, June 25 year ends. So we've actually seen their June 25 results as well. We definitely have seen the VNB margins come under strain. And that is, again, there's many things at play there, but one of the things that's driving that is volumes of new business. So the insurance groups are struggling to get enough new policies into the doors.
So it's a good earnings coming out of the policies that have been sold over the last 20 years.
Yeah.
But not good growth in terms of new product acquisition. What do you see as the drivers of that from a macro and an insurance perspective?
I'll answer it, but then I'm going to ask you that same question, right? So maybe one little stat before I get into that is a lot has been said about IFRS 17, and not always kind words of late. And I think that's a topic we've reported on extensively in the Outlook publication in years gone past. But the one thing that IFRS 17 has given us that was completely absent under IFRS 4 is more comparability. Right, so I'm not going to say absolute comparability, but insurers need to adopt the same accounting policies within the confines of IFRS 17. And one of those is, one of the products of IFRS 17 is CSM, contractual service margin. Now, contractual service margin, in simple terms, is the future profits that you will earn on the business that you've underwritten to date. Now, the one thing we've done in the Outlook publication, in that article I've referenced, is we aggregated the movement in the CSM for those 5 insurance groups from the opening to the closing. And you can see what portion of the CSM that was there at the beginning of the year was taken out and recognized through profit and loss, and what CSM was added for new business. And again, there's a few nuances there. In addition, for those technocrats, what's also in that number is where you've made assumption changes about future cash flows that you fund from the CSM. But the overall message that comes from that is that there's an 11 billion rand gap between what those 5 insurers took out of the CSM and recognized for P&L as to what they put in terms of new business. Now we come to why. Now, it is volume-based for sure, and it is also insurers are unable to, in the current environment, able to sell new business at the same margins than what they were able to do 10, 20 years ago. So it shows you there's a change in what the consumer wants. And again, I think it's a function of competitiveness in the market and the consumer able to find a product that better suits their needs, as opposed to taking on a product that has been structured and it is a take it or leave it perspective. Interested in your views here.
Yeah, so I think at the, and let's call it the micro level, that's exactly what we're seeing. I think this was always a factor when we were looking at the transition to this more, the information you can now get out of IFRS 17 and how it impacts earnings and earnings growth. But from a macro perspective, if we look at the macroeconomics of particularly the South African market, affordability is a massive issue.
Yeah.
A few weeks ago, the ASISA launched the Insurance Gap Survey, and a lot of the commentary around that was around there is still a very big theoretical gap between how much cover people need and how much cover people have got. But when digging it down into a little bit more detail, the researchers for ASISA recognize that there's affordability issues in terms of the ability to pay and the other pressures that the consumer has and where insurance fits in the priority of needs. So I think the insurers, particularly from a South Africa perspective, in a low growth environment, from an economic perspective, and a lot of cost pressures coming in with slightly higher inflation over the last year or so, have definitely seen challenge to get the consumer to buy insurance. The other thing, I think, for the incumbents, the large insurers, is there are a lot more specialist insurers that are bringing a different distribution model, different product set, different value proposition, that are competing for the same business that the incumbents used to compete with, and that is driving the price down. I suppose that's a good thing for the consumer in terms of value for money in the insurance space, but it does require the incumbents to respond to that by changing some of their distribution and product strategies, and also be more efficient at the back end. They're carrying a large legacy cost base, and that drives the ability to carry. They have to carry that cost in the product itself. And so the margins are coming down. And this has been, if we look at it over the last 10 years, the new business margins have been coming down. There's been a lot of attempts to try and pull them back up into the 3-4% levels, which is where they were historically. They're now in the 1 to 2% level and struggling to get out of there back into the let's call it the 2015 type numbers that we used to see.
Absolutely. So that's a very good point that you make there. Well, maybe there's 2 points I want to pick up there. So look, and if we stay in the life insurance environment, there's the affluent market segment, and there I think we definitely have seen the strain. But historically, insurers have been able to report better margins on the entry level market. And yes, there's the affordability item there. But what we have seen is there's new entrants that in a rapid space of time have been able to take a large part of that entry-level market, which have historically been underwritten by these 5 insurance groups. Right? And I think a point that you made yesterday was we need to think about how we structure this publication going forward to make sure we deal with the diversity of the industry, but also we make sure we get all the role players as part of our analysis. So there is some work, there's some homework in the future. But the one thing that insurers have had to do is look at the expense base.
Yeah.
And in these 30 June 25 results, you'll see references to insurers making commitments on expense savings to cut their costs in line with their new business volumes at the moment.
So moving, before we move off the numbers, I think from my perspective, and thanks for that analysis, I think what we're seeing, and we discussed it last year in our survey as well, different stories in life and short-term insurance as expected in the business models. We hope that the purple patches you talk about it in the short-term insurance market continues. I think the short-term insurance insurers are hoping that too. And the key pressure on the life insurance side and the savings side, which often attaches to the life insurance side, is how to get more effective growth and more efficient growth. And I think a lot of the cost base in terms of margins needs to be taken out the front end. And I think at the front end in terms of distribution, and those new entrants that are coming in have got a much cheaper delivery model than the incumbents do. Consumers still need advice. Consumers still need to be able to be advised into the product, but how to do that more effectively.
100%. And again, I want to stress, I wish for the purple patch, for the short-term insurers to continue. If you analyze it, you know it won't, because a simple calculation, taking the profit after tax for the short-term industry as a whole and divided by their equity, gives you a return on equity for the whole industry of in excess of 20%. That's not sustainable. And I wish if I could touch wood, I would touch wood, but it tells you the winds of change are going to, just that we've been around long enough to know it's
not called the insurance cycle for nothing.
Exactly.
So moving, and if we just took, we talked a lot about the South Africa market. I think our survey also looks at just generally what's happening in East and West Africa. Slightly different macro and insurance industry perspectives, a lot lower penetration, but once again, still facing customer acquisition pressures, but responding to it in a slightly different way in terms of how they're partnering with other entities to try and get their growth. Overall perspective from your side, without going into the sort of deep detail of each of the territories, is your view of where East and West is. Our global survey talks to the opportunity set that the young up and coming middle class in Africa is giving the insurers, and we're going to start seeing that. We are seeing that in the East and West Africa markets.
Yeah. So in our publications, our global industry leader, and he talks to exactly that point about the opportunity that there is for the industry in Africa, considering the youth, right? So. And he's right. He's right. I think the one thing that's similar South Africa to Africa is affordability remains an issue. So the consumer is constrained all around. The one thing that I think is slightly different is the trust factor. So as a general rule, the South African insurance industry has done well to build and maintain trust with its policyholders. It's far more fragmented in Africa, and that's our bold, broad statement. So that there are pockets that is true and others not. But I still think the challenge of African insurers is to continue to build trust with policyholders. Now, a point I know you are passionate about is how you can use technology to do that. So a further challenge that the African insurers have had is the ability to collect premiums and do it in a cost-efficient manner. Again, technology is able to offer some new opportunities there. So again, this point of a young population in Africa with technology, and yes, we've been talking about it for a number of years, but it is true. There's a number of items there that, if put together, could lead to exponential growth in Africa.
Yeah. So we'll get to that at the end of this discussion as we flow through the agenda of our, or at least the agenda of our outlook.
Yeah.
I think this year's outlook's been quite interesting. Over the last 3 years, it's been very heavily regulatory orientated in terms of lots of changes in the regulatory space. And if we look at where we're at now, I think the key thing around where regulations are is that it's stabilizing, or it's actually leveraging a stable regulatory base over the last few years, particularly from the prudential regulatory environment to the financial reporting regulatory environment. Those transitions have now happened, and I think what's key and what we've unpacked in our regulatory space is how to use both the financial reporting transformations in terms of IFRS 17 and the solvency regulatory changes that have happened historically from a while ago under SAM in South Africa and the risk-based capital regimes in East and West Africa. They work off a common base, and what we've talked about in our publication is how the underlying, particularly actual modeling environment and the thinking about how to do performance management off that base can now be leveraged. They're not the same, and our article by Victor and Takolani actually unpack how to think about the regulatory versus the financial reporting bases, and how the insurers can leverage those. Your perspective on discussions with insurers around their finance and risk functions and the importance of actually putting that thinking on the table now that the regulators have mostly stabilized what they're wanting from the insurers.
Yeah, look, I think the industry is starting to prepare itself for a new wave of prudential regulation at some stage. As you say, there is a cycle there, but I think you're right that the industry, from a regulatory perspective, have settled into some form of a rhythm when it comes to reporting. And in my perspective, I think the prudential regulator will be happy that I think the industry understands risk-based capital and uses that in decision making. I'm not saying that there's no economic capital models also out there, but I think regulatory capital, from my vantage point, is a key ingredient in board packs. And the one thing that I think you alluded to is that often historically there was a financial reporting environment and there was a regulatory reporting environment. And yes, they almost happened sequentially. You first did your financial statements, and then that was used as a base for your prudential regulatory reporting. We are seeing more insurers running two streams now and not sequentially at the same time. And I think that's a function of insurers becoming more comfortable with the regulations. And as I say, it is actually part of their reporting into their governance structure.
And then, in our article, in our publication as well, we look at the importance of and how to consider transforming, in particular, the actuarial function. And I think this talks to bringing a common base together. If we speak to the finance teams and the actual teams in insurers, they've become very concerned around the increased cost base for delivering exactly the same not exactly the same, an output that achieves the same objective, whether it's financial reporting or prudential reporting. And so really important is how the finance and actuarial teams are looking at both their operating models and the systems environment and inside that operating model to optimize it. There's a lot more pressure, let's call it, from the product houses who are ultimately paying for the back office functions to find out how we're getting better outcomes, both from a proactive risk management or a predictive financial outcome out of a system that has a large amount of investment that has been put into it over the last 5-10 years.
I couldn't agree more. I see that often. So the question is, how could we do this cheaper and better? And
faster.
And faster for that matter. And it is that function again. If there's focus on expense savings, that cuts across the whole business, not just the underwriting and the operations. It includes the financial reporting.
But as you were saying, there's some you call them headwinds, depending on who you're looking at it, or just general focus by the Prudential Authority on certain aspects of insurers.
Yeah.
They get their feed from the global
Yeah.
insurance supervisors.
Yeah.
And one of those is liquidity risk for insurers.
Yes.
And so there's a lot of resistance to some areas where the regulator is looking at liquidity risk
Yeah.
and trying to understand it. We have seen some pressure on some insurers
Yeah.
around liquidity. But I think the road is it's going to be carrying in. And one of our articles by James does unpack a sub-element of that, and that's actually looking at the treasury function,
Yes.
the cash management function. And it's quite interesting, having looked at the insurers, is that because we're so balance sheet focused and actually is looking at large quantities of assets, let's call it the core liquidity management and treasury functions of insurers can generate significant value for the insurers in terms of optimizing and standardizing some aspects of dealing with bank accounts and just some basic functions that are dispersed across the organizations and sometimes can be optimized quite effectively.
No, for sure. So I don't want to talk outside the bedroom, but I have a few clients where I think in risk committee meetings, the highlight of the agenda is meeting with the treasury function, the BSM function, balance sheet management function.
Yeah.
It is exactly that. It's the flip of risk and opportunity.
Yeah.
And yes, I think insurers are recognizing both, that they need to manage their risk, but there definitely is opportunity to improve performance.
Yeah. And then I think that's, given the cost base of supporting financial reporting and risk reporting, any areas of additional value to be created is key, and the areas to look at. But let's call it the matter at hand in some respects, because we were talking about earlier, which is really around insurance industry is here to service the customer.
Yeah.
And I think, as you were saying earlier, if we start looking at what shifts are happening in the industry that are enabled by customer or enabled by technology, but informed by customer preferences and competition, we are seeing the promised emergence of big technology transformation coming through in some form or fashion. The two key topics that we look at in the outlook this year is actually around the intersection between cloud computing and artificial intelligence, and where that is actually coming to the fore. I think we've had discussions around the promise of artificial intelligence and the promise that cloud computing can deliver a more optimized result from the technology space, cost optimization. It has taken a long while for the insurance industry to invest in that. I think the legacy platforms and the legacy they have meant it's taken a while. But over the last year, having a lot of discussions with the technology teams inside insurers, we have seen quite a high degree of engagement with what we label the hyperscalers, Amazon Web Services, Google, and Azure, and how their insurers have moved a lot of their computing and data storage off their own premises into the cloud environments. They're a lot more comfortable with the platforms. I think having some of the hyperscalers having data centers in South Africa has definitely helped, and they are very prevalent in the country. But I think the other thing is the speed at which AI has developed and the interconnect between the cloud computing strategy and how insurers are starting to deploy real, tangible artificial intelligence solutions on top of their environment is coming to the fore.
Yeah, no, for sure. Look, I'm the first to admit I'm the accountant here, so and I think your exposure to that part of the industry is more than what mine is. But I do find that you're right. The pace is rapid, and even 5 years ago, people would say, we're building a bot here and it's going to do. Now it's almost like it just happens and people don't talk about it because it is becoming part of the culture of an organization. So they look for ways of doing exactly what you're saying, using technology to better serve the customer. So and without any fanfare. That's the part I enjoy. Yeah.
No, and I think as a consumer of
Yeah.
the industry, it's good to see
Yeah.
that. I think interestingly, and you started talking about it earlier in terms of what products does this industry now deliver to customers,
Yeah.
and what's happening. I think the extent to which almost all of the listed insurers and a couple of non-listed insurers or insurers that are not classified as insurance groups are now into the full value chain, including credit and let's call it banking and transactions and payments. And so the full suite of offerings are available.
Yeah.
And the technology has enabled much better integration across back office systems in terms of policyholder record keeping systems, so that the front end looks seamless to the customer. This has been let's call it the holy grail of single view of customer for insurers and for financial services providers for many years. And the original, the way to solve it historically has been attempting to pull all the data in one place, and then try to do the matching in the data side. The ability to do that at the front end across the platforms is becoming more apparent. And we were talking about it off camera, but the extent to which, if we look at the customer and the ability to build trust with the customer, as you were saying, is often linked to how often the customer interacts with the brand or the offering. And I've got a heuristic view of the world, and the average consumer, and I haven't done research, but it's heuristic, is 1,000 connections with your bank in terms of your transactions. You'll probably connect with your health insurer or your medical scheme 100 times. Your short-term insurer, if you're unlucky, 10 times because you're claiming from them, and then you're renewing every year. But your life insurer generally at the beginning and often at the end of that, the product life cycle. And so the ability for now these integrated financial services companies, which we probably need to rename in terms of our survey and not call it the insurance survey or insurance outlook, is actually the ability to look across all of those interactions, build trust across all of them, as you were saying earlier, is now much more possible. And it links into the broader, particularly banking strategies of the insurers who are now going to be big banks at some point in the future.
No, for sure. So within this same month, I looked at the analyst presentations for the big insurance groups, as we mentioned, and we always stay up to date with the financial press. But you could see, Discovery reference how they're going to use the bank technology from a group perspective. Old Mutual is launching its bank, but what they emphasize is they're going to use the bank technology as part of their communication with the customer. So the bank will be at the center. And Sanlam and Time are building a super app. It does exactly what you've said there.
Yeah.
It's there yes, there's definitely a banking angle here, but it definitely helps you build a constant communication with a customer that you would otherwise have very infrequent interactions with. It has to be good for the industry.
And so we've sort of skirted around it in the discussion on the result. And Liberty inside Standard Bank fits this mold, but we haven't mentioned Capitec, Nedbank, ABSA, FirstRand, in terms of key providers of insurance products in the insurance market. And these are big financial services brands with strong trust. In a lot of discussions with clients, the entry of Capitec into the insurance market and actually getting their insurance license is a big thing. And you pointed to it in terms of the bottom end of the retail mass market. And I think, as we were saying, that's one element of what we are calling convergence. And we have an article on convergence in terms of insurance and the insurance market. But in reality, if we look beyond the banks and the insurers and the bank assurance model, as it's been labeled for many years, we're seeing the likes of MTN, FinTech. We're seeing the likes of Vodacom Insurance with very specific insurance products. We're seeing retailers like Woolworths and Shoprite Checkers all playing in this insurance space. And it is changing the fabric of the insurance market and the way that consumers get access to very specific products to meet very specific needs.
For sure. And look, the one you mentioned, the bank assurance model, and in the past one would normally say it's the bank that owns the insurance company. We're now seeing the inverse as well, but it doesn't mean some of those names that you mentioned is the bank still owns the insurance company. I think the bottom line is it's this integration element that's more important. It's not all just about the customer. It's the point that you made earlier, and we spoke about. It's how you interact with the customer. It's not just whose customer is it. If we can integrate and communicate together, it is better for the ecosystem.
Absolutely. And as you say, so the old bank assurance model really was just a higher level distribution model. I think it still is in certain circumstances. The insurer is looking to access the bank client base. They put a distribution capability inside branch, so it's a point of presence. And in some of the old bank assurance models, that was really what it was.
For sure.
I think the new world is that the transactability and the digital prominence of digital banking transactions is coming to the fore. And whether it's through a cell phone company, whether it's through a bank, whether it's through the online portals of the retailers, it's all an area where financial services can be delivered. And the specific of the product, the standard, the insurance model stays the same. But how it's delivered effectively, and how the consumer gets best outcome is really what the overall insurance industry looks for.
And maybe one more angle on that bank insurance. And sometimes quite a sensitive thing is, but you want to get closer to the payment system.
Yes.
Right. So, we've always said that the South African insurance industry has had the benefit of a strong banking system and being able to collect premiums. What we said some of the African counterparts have struggled with. But if you can be closer to a payment system that you trust, and there's many intricacies in that, which, again, I'm not going to try and profess as an accountant to understand fully, but I can see our customers wanting to manage how they integrate with that payment system.
And there are big changes. I think we've seen it in the press around what particularly the South African Reserve Bank wants to do with the entire payment system, bring down the cost of transactions across the system. And a lot more people want to participate in that. So democratizing payments, access to customers' bank accounts becomes critical, as much as it's access to customers' financial data that sits within the bank account. And just to start wrapping up this discussion, our discussion on convergence in the outlook actually takes a interesting regional approach to it. And from a South Africa perspective, where there are large incumbents, a lot of the convergence requires the incumbents to be able to respond to that, recognize that there are different distribution models, either enter equivalents or find different ways to deliver the same value using their brand and much bigger, let's call it face-to-face footprint.
Yes.
To your point, in terms of the non-South African African territories where insurance is prevalent, the trust is not as high in the brand of the insurer, and the insurers are partnering with other players to jointly bring a more prevalent brand into the market. And I think it's definitely happening with the telecommunications companies, with the interaction with the payment system. So it's a bit of a tale of two cities, and I think there's an opportunity for insurers to increase penetration in the East and West African markets. But there's definitely a need for the broader, the incumbents in the South African market to respond to what's happening. And I think, as you said at the beginning, and this is where we'll close, I think we need to rethink what we call this outlook and how we look at it. And we definitely are looking at the insurance market differently in terms of what constitutes the market. And if we look at it, to close, the insurance market historically has been dominated by the large established insurers. I think they will still dominate the market for a large degree. But the incumbents, well, not at least the new entrants, some of them established insurers, some of them entering the insurance market are going to start playing a bigger role. And so how we would continue to look at the insurance market is not necessarily through the lens of what is an insurance company, it's actually who provides insurance and savings benefits to the South African market and how do we support them. And so whether we're dealing with a bank, whether we're dealing with a retailer, whether we're dealing with an incumbent large insurer, we're looking at it through the level of the value chain of insurance to make sure that we're delivering on the insurance promise, we're able to help our customers deliver on those promises. Thank you, Gerdes. It was a great conversation.
Thanks for having me.
Looking forward to doing this again next year.
Indeed.